What if I told you that billionaires like Elon Musk, Jeff Bezos, and Warren Buffett pay almost zero income tax legally every single year? And what if I told you the exact strategy they use is available to regular real estate investors right now? Stay until the end of this video because at the 5-minute mark, I'm going to show you how a short-term rental property can eliminate your W-2 tax bill completely and legally, using a strategy the IRS absolutely does not want you to know about. This changes everything. Here's the uncomfortable truth about how money and taxes actually work in America. If you have a job, a W-2, a salary, even a high-paying career, the government takes their cut before you ever see a single dollar. Income tax, payroll tax, Social Security, Medicare, gone before it hits your bank account. But here's what the wealthy figured out a long time ago. Asset owners, people who hold stocks, real estate, and businesses, they don't pay taxes on wealth that grows. Why? Because in America, you only pay taxes when you sell, and the wealthy never sell. That one sentence is worth more than 4 years of college. You only pay taxes when you sell. So what do the wealthy do instead? They borrow. Here's the strategy in plain English. Step 1, you buy an asset. A rental property, a stock portfolio, a business. Step 2, that asset grows in value. Step 3, instead of selling it and triggering a massive capital gains tax bill, you walk into a bank and you borrow against it. You do a cash-out refinances on your property. You take out a portfolio loan against your stocks. And here's the key. Borrowed money is not income. The IRS cannot tax a loan. So you now have hundreds of thousands of dollars in cash, tax-free, while your asset keeps growing, keeps generating equity, and keeps working for you. You didn't sell anything. You didn't trigger a single dollar of capital gains tax. You just got paid tax-free. This is not a loophole. This is not illegal. This is literally how the system was designed for owners. Now, here's where this strategy becomes absolutely dangerous in the best possible way. You take that borrowed cash and you buy another asset. That new asset appreciates. You borrow against that one too. Now you have more cash, still tax-free, to buy another property. Rinse and repeat. This is called the wealth flywheel. And once it starts spinning, it almost never stops. Every cycle you go through adds more equity, more borrowing power, and more assets, all without ever selling, all without ever triggering a tax event. And when you eventually pass these assets to your family, here's the part that will make your jaw drop. When your heirs inherit your assets, they receive them at the current market value, not what you paid for them. Decades of unrealized gains, completely wiped clean. Gone. Your family inherits the wealth. The IRS inherits nothing. This is called the step-up in basis at death, and it is 100% legal. Okay, this is the part I promised you at the beginning. This is how regular real estate investors are wiping out their W-2 tax bills completely and legally using short-term rentals. Here's how it works. When you own a short-term rental property, think Airbnb, VRBO, and you materially participate in managing it, the IRS classifies your losses from that property as active losses. Not passive, active. That matters enormously. Now you combine that with a strategy called cost segregation. A cost segregation study breaks your property down into components, appliances, flooring, fixtures, and accelerates the depreciation on those components dramatically. Under the 2026 tax law, 100% bonus depreciation is now permanent, meaning in year one, you can depreciate a massive chunk of your property, S value, and use that as a paper loss to offset your two income dollar for dollar. You could buy a $400,000 short-term rental and legally show a $150,000 loss on paper, eliminating your entire salary tax bill for the year, while in reality that property is cash flowing and appreciating. You win twice. This is exactly what billionaires do, just at a bigger scale. They take minimal salary to stay in a low tax bracket. They hold appreciating assets, stocks, real estate, businesses. They borrow against those assets to fund their lifestyle, tax-free. and they use depreciation and paper losses to offset any taxable income they do have. The only difference between them and you right now is that they started. The 2026 tax law actually made this easier than ever before with the increased estate exemption and restored 100% bonus depreciation. The window is open. But windows don't stay open forever. The question is not whether this strategy works. It absolutely works. The question is whether you're going to step into the owner mindset or stay stuck in the worker mindset forever. So here's your action plan starting today. Step 1. Stop thinking like a worker who earns and spends. Start thinking like an owner who acquires assets and borrows. Step 2. Look into a short-term rental property in your market. The combination of cash flow plus bonus depreciation plus material participation is the most powerful tax strategy available to everyday investors right now. Step 3. Get a cost segregation specialist and a real estate savvy CPA on your team immediately. The right advisor pays for themselves 10 times over. Step 4. Drop the word owner in the comments right now so I know you watched until the end. And I will send you a free resource on how to get started with short-term rental investing in your area. Follow this channel for weekly strategies on building real wealth through real estate, smart tax moves, and the owner mindset. The wealthy have been using this playbook for decades. Now you have it. The only thing left to do is start.